Let's get more on the outlook for M&A and retail with former Toys R Us CEO Gerald Storch. Jerry, great to have you with us. What do you think is in the air at this point in the business cycle that is creating the stir in retail M&A?
Well, it's not at all unusual when you have troubled businesses or sectors to look at different solutions. If you were the Nordstrom family, I'm not surprised at all they're looking at something different. Basically, their stock has been marooned at the same level for over 20 years. And they made an offer before. It was rejected by the board. It's kind of tough when you're inside. You need the board to approve it and all kinds of things when you go private transaction. But what they're doing clearly isn't working, particularly for department stores. And so there are obvious parallels between the Nordstrom situation and Macy's ones. In both cases, they're looking to see, can we take this private? Because when we're private, maybe we can run it differently and do things that are more revolutionary in terms of the business model. You know, because you can make changes outside the public eye without that kind of glare of having to make every quarter. And so they have in common this notion that being private might be a better way to run it.
It's Karen, thanks for being on. The history of retail is sort of littered with leverage buyouts that didn't work. And so what do you think the new model is, given where rates are? How much equity do you think you need to have to be able to do a deal where the company isn't burdened by too much debt?
Well, I think the first deals done in retail were done at higher leverage ratios. You look back, I saw a study recently. It's very clear that was true. There was a sense these retail companies were cash machines and could keep spinning off that cash. But then you had, competition from the internet, for example, e-commerce and Amazon, and need to invest in this whole new platform on top of everything that you had in front of you. And you had rising competition in the case of the department stores from the off-price retailers like TJ Maxx and Ross stores are growing. So people recognize that. And so the new leverage that would be applied to these companies, I would believe, would be less than what you saw in the early private equity deals. So people have gotten smarter as they've seen the history of what's going on here.
So, Jerry, just a sort of on the side of Karen's question there, what do I make of this environment right now as far as retail? Is it, to Dan's point, stock pickers, which we could all agree with? What do we see in the environment? What's the landscape right now in the cycle of retail companies?
Look, there are clear winners and losers. That's what's going on. You say stock pickers. I mean, some companies are doing well. The consumer is clearly getting stretched. The most recent retail sales reports, last 2 months in a row, clearly were not good. No matter what you want to say about what happened last fall or didn't happen last fall, it hasn't been so good lately. But companies like Walmart or TJX or Costco or Amazon have done well regardless. And consumers are flocking to those names. And you mentioned Five Below tomorrow. I would expect similar kind of results out of them. There has been very little change, by the way, in who these winners and losers are. If you go back and look at what happened in the third quarter of last year compared to the fourth quarter, almost every retailer that posted negative same-store sales in the third quarter posted very similar, by the way, negative same-store sales in the fourth quarter. Same thing as you look at companies that were positive, again, like the Walmart, TJX's. Very similar numbers. They didn't even change very much. So Walmart was up 4.9% same-store sales in the third quarter, up 4% in the fourth quarter. The stocks may bounce around on the earnings days because expectations have been set for differential performance. But then what you see is they're doing the same thing they did before. You know, in the case of the department stores, they were pretty steeply negative in the third quarter, and they're still negative in the fourth quarter, and the outlooks aren't very good. Similar for a company like Target, which has historically been a great performer. They were negative 4.9 same-store sales in the third quarter, negative 4.4 in the fourth quarter, while Walmart was up 4.9 and 4. So, that gap is one of the highest in history. So the winners are clearly winning, and the losers clearly aren't doing so well. If you want any single metric in retail, look at same-store sales. That's going to tell you what's going to happen over any meaningful long cycle.